multifamily real estate could be heading for a major crash in 2023. And if you're confused by that because I've repeatedly said that I don't think real estate is heading for a crash, let me just explain that when I say that, normally I'm talking about residential real estate. That's single-family homes and pretty much any type of property that is 4 units or less. And I stand by that. I still think that prices are likely to go down in 2023 by a couple of percentage points, but I don't think we're going to see a crash in residential real estate. Commercial real estate, that is basically any property that is 4 units or over. It also includes retail, office space, industrial, and all that. But today I'm mostly going to talk about large multifamily properties. That market, that commercial real estate market, works very differently than residential real estate, which I'll explain in a little bit. What's going on, everyone? My name's Dave Meyer. I'm the Vice President of Data and Analytics at BiggerPockets. And if you like this type of market analysis and deep analytical view into real estate, I highly encourage you to check out my podcast. It's called On the Market. It's made by BiggerPockets and sponsored by Fundrise. And every week, me and a panel of expert real estate investors discuss topics just like this. Let's get into today's topic, which is the commercial real estate market and why I think there is a lot of risk in this market right now. And if you watch my videos and have watched me over the time, I'd like to think that I'm not an alarmist. I am not someone who's been calling and saying that there's going to be a crash in real estate over the last couple of years. I know that people, a lot of people on YouTube have been saying that there's going to be a crash since 2014. I'm not really one of those people. Last year, in 2022, I said that I thought prices would rise nationally year over year. That's exactly what happened. They just, in December, those numbers came out. It's up about 2 to 3% year over year. This year, back in October, I said that I think housing prices, residential real estate, will go down somewhere between 3 and 8%, declines of 3 or 8%. That's nationally over the course of 2023. And I'm sticking by that. I still think that is the most likely scenario. So I'm not really a person who thinks everything is going to crash. But the fundamentals of commercial real estate, specifically multifamily, make me think that there is something going on here where asset values could take a pretty steep dive. First, let me just say that residential and commercial real estate are different, and I'm going to get into this in just a minute, but basically residential is driven by homeowners. Even though there has been an increase in institutional investors, second home buyers, people who just own a few properties, 70% of the residential real estate market is still home buyers, just people who are buying a house to live in. That is still 70% of it. And those people just have different calculations than commercial real estate investors. They are looking for a place that has good schools, that fits their family, that's near their family, all these other considerations. Whereas commercial real estate, it's just about logic, right? That's how investors work. They just want to chase the highest yield, the best possible return. And so that's why commercial real estate is valued in a more mathematical, analytical way. And they do that by using something called cap rate. And cap rate is a little bit confusing. People get confused about it because it does serve multiple purposes in the real estate world. But basically what it is a measurement of market sentiment, right? So it's basically how much are buyers willing to pay as a percentage of the total revenue of that property. And I'll get into this in a little bit more. Can help you understand what the cash of cash return is for an all cash deal. And it's also used to calculate values in real estate. All right, we're gonna head over here to the whiteboard and explain basically how commercial real estate is valued and then some of the market conditions that make me think that values are going down. So if you wanna value a property in commercial real estate, you take this formula, purchase price, which equals the NOI divided by cap rate. NOI is net operating income. It's pretty simple. Basically, you take all of your rent, you subtract your operating expenses. That's how you get NOI. It's a good proxy for profit. It doesn't include debt costs or CapEx, but it is a good proxy for the amount of profit you'll have on a property. Then you divide that by cap rate. And as I said, cap rate can be a little bit confusing, but it's basically how much someone is willing to buy or sell for. You take your NOI and you divide it by cap rate. And cap rates really vary depending on the type of asset, where it is, the quality of the market, all these sorts of things. And what it comes down to is what someone's really willing to pay for that asset. Buyers, generally speaking, want to buy at a high cap rate because that means that the property price is lower. Sellers want to sell at a low cap rate because that means the property price is higher. But what they can agree on is really what they can agree on. No one sets cap rates. It's a function of the market. And so just to show you how this works, and how important cap rates are. If we look at this one, property one over here, you can see that it has an NOI of $100,000, that's a net operating income, and a cap rate of 10%. As I put up here, the purchase price equals NOI divided by cap rate. If you do that, if you divide $100,000 by $10,000, you get a purchase price of $1 million, right? Okay, cool. Now what happens when we look at a similar property that has the same NOI, right? The first one had 100,000, this one's 100,000. But we're changing the cap rate now from 10% to 5%. So it doesn't sound like a lot, but when you divide 100,000 by 5%, you now get $2 million, right? So now you can see that even though a 10% to a 5% cap doesn't seem like a big difference, it really is. It doubled, it changed the valuation by double, right? Now, let's just take a step back. When you're an investor and you want to buy commercial real estate, like a big multifamily, let's just say, imagine it's an apartment complex, right? You want to increase value, right? That's how you make money for yourself. If you're syndicating, that's how you make money for your investors. And there's basically, now given what we know about cap rates, there's two ways that you can do that. You can either increase your NOI, right? Make more profit, or you could sell at a lower cap rate. Remember that, look at how this worked. All we did was sell property for lower cap rate, and this seller would have been able to make $2 million. So there are two different ways to do it. You can either increase your profit or sell at a cap rate. So let's just look at this over here. The ways that you can increase NOI are pretty simple. You can raise rent. That's a good way to increase your profit. You can lower your expenses. That's a good way to increase your profit. Or you can improve efficiency, overall operating efficiency somehow. That can all increase NOI. And we get down to the math of it. Just do this quickly. NOI at 150, cap rate of 5%. That is a value of $3 million and an ROI of 50%. So you can see that in a similar situation to what we had up here, rather than 100,000 of NOI, we have 150,000. That gives us $3 million valuation. Congratulations, you just made 50% ROI. Property 2 here, though, let's just look at how you can make more money selling at a lower cap rate. Remember, let's say we had the same NOI as we did up here, but now instead of selling at a 5% cap rate, right? Remember up here we had a 5% cap rate. Now we're selling at a 4% cap rate. All we need to do to calculate value, divide 100,000 by 4%, and now we have a value of $2.5 million, which gets us an ROI of 25%. So now you can see there are basically two ways that you can make money by buying these things. You increase ROI, NOI, or lower cap rate. All right, thank you for sticking with me. That's really important to understanding why I think there's going to be a crash, because basically you have to figure out, are either of these things possible in the current market conditions? Can you raise NOI? Will cap rates go down in your area? That's basically the question. Oh yeah, I forgot to talk about this before we move on. Ideally, you do both, right? So if you go to property 2 and you raise NOI and sell at a better cap rate, then you get a valuation of $3.75 million, and that gets you the best ROI here of 87.5%. So now that you understand how investors make money in commercial real estate, and that again is just by either increasing NOI or selling at a lower cap rate, now that you understand that, the question is, if you were to buy now, can you realistically do that? Can investors realistically increase NOI right now, or can they sell at a lower cap rate? Now, let's look at these market conditions and decide. First, we're going to go to the left side here and talk about NOI. And the best way to forecast at least your ability to increase NOI really comes down to rent, right? That's how you gain more money as a commercial real estate owner. And if you look at rents, we all know they have been blowing up over the last couple of years. You can see this chart here that shows for multifamily across the entire country. As you can see on this blue line, rent was going up pretty steadily from 2013 till about 2021, where it just exploded. But since then, as you can see at the beginning or about middle of the way through 2020, if you see where my red line that I'm drawing here is, you can see that rents actually started to go down. And it's not a lot, but it does show that rent growth has significantly cooled off. We're not seeing the torrid pace of rent increases that we were seeing over the last couple of years, and that makes sense. The amount of the pace at which rent was growing over the last few years, it was too much. It just couldn't sustain itself. And in my opinion, we've actually pulled forward a lot of rent growth over the next few years. I've been saying for a couple of months now that I'm expecting little to no rent growth over the next 2 years. I could be wrong, but I would rather be wrong and see rent grow than to assume rent is going to grow and put myself in a bad investment. And so I think this is really important here to see that rent growth has really leveled off, and given economic conditions with an increase in layoffs, with inflation, with economic uncertainty, I think it's unlikely rent is going to grow in the near-term future. The other thing on this chart that you should be paying attention to is this orange line, which shows vacancy. that had been pretty stable over the last decade or so. You can see this line has like a mild upward trajectory from 13 to 20, but then it absolutely tanked in 21, and we saw really very historically low vacancy rates in multifamily real estate in about 4.5% throughout 2021. But as you can see, we're reapproaching historic levels. And I don't personally yet see any data that indicates we're going to see huge amounts of vacancy. That could all change, of course, if the economic picture changes significantly. But we are returning to a more normal level of vacancy, which suggests at the very least, we should be expecting slower rent growth. And as I just said, I personally think it's going to be pretty flat. The other thing I think that's important, this is a little bit more wonky, but there's something called absorption rate, which measures supply and demand in multifamily. Basically, if absorption rate is positive, like it has been for almost this entire chart, it means that there is enough demand to meet all the construction that's going on. When it turns negative, it means that there's more construction than people have demand for. And as you can see in Q4 of 2020, the absorption rate turned negative, which indicates that there is some risk of oversupplying the multifamily market right now, given the economic conditions. That doesn't mean long-term there's too many markets, but it just means there's not enough household formation right now to create enough, to necessitate the amount of units that we have. If you want my opinion, is it going to be easy to increase NOI for multifamily operators? No, unless you're doing value add. If you're buying a distressed asset, fixing it up and improving it, you could definitely still raise rents and improve your NOI. But just like macroeconomic conditions are not going to support market appreciation right now, in my opinion. Now let's move over to the cap rate side. Remember, just to recap, the ways you can increase value as a multifamily investor is either increasing your NOI or selling at a lower cap rate. Over the last several, decade, this has been easy for real estate investors. As you can see here, for the United States, cap rates have really just been going down since the last decade almost. It used to be for this green line, they used to be at about 6.5% in 2013. Now where we sit today is somewhere around 5%. Personally, I don't think it's going to go any lower. And I'll explain that in a couple of ways in a minute, but just look at this graph. Do you think, when economic times are doing well, cap rates tend to go down a bit? Economic times are uncertain. You can see here, even in this CoStar forecast, they are forecasting rates going up a little bit. There are all sorts of reasons for that. One is because there is more risk in the market, and so buyers are not willing to pay as much. There are other asset classes that are offering pretty good returns, and the demand for commercial real estate is probably coming down. But the main thing I wanted to talk about, why I think cap rates are going to go up, is due to something down here. What I'm showing here is an analysis I did about market cap rates against interest rates. And this is a little bit wonky, I know, but just follow me for a second. Basically, what happens in most real estate is that you want to use debt to purchase assets, because when prices are going up, you get something called positive leverage. And that usually means that the debt is accretive to your value. That means it adds value to your investment. Actually, taking on a loan, I know that sounds contradictory because you're paying for the loan, but given in the right conditions, if you're buying real estate right, taking on a loan and using debt is actually beneficial to your investment. When interest rates get above your cap rate, it is no longer beneficial for you to be using debt unless rent is going to go up a lot. And I just told you that I don't think rent is going to go up a lot. So this creates a situation where there's very likely negative leverage. That means it is not beneficial to use debt. And there aren't a lot of historical references for this in the last 20 years, which I have data for. But I do want to just point out that during the Great Recession over here, where I'm drawing these red lines, you can see that the prime rate for interest rates went above cap rates. And what happened? Cap rates increased. You can see that they went up by about 100 basis points. And 100 basis points doesn't sound like a lot, but it really is, as I'm going to show you just in a minute. So for all of these reasons, I don't think that cap rates, just on market conditions alone, are going to go down at all. And that's not good for sellers. It is good for buyers because it means that the asset values are probably going to go down. Okay, so let's just talk about what happens now. Personally, as I just said, I think there's a very good chance cap rates rise. I don't know for certain, but I think there's a good probability that they do rise. And if cap rates rise, values go down. That is how commercial real estate works. Unless you're increasing your NOI, which I think is unlikely, if cap rates rise, values go down. Let's just revisit this example I was showing before, which, just to remind you, we had a property that had a fictional NOI, net operating income, of $100,000. To figure out the value of this, all you have to do is divide this $100,000 by 5%, and you get $2 million. That's what this property is worth. If we just raise this cap rate to 6%, just 100 basis points, same NOI, the value of that property goes down to $1.666 million. That means that you have lost 17% of the value of your property by the cap rate just going up 1%, just 100 basis points. So this is the reason why I said at the beginning of the video that I think we could see significant declines in commercial real estate values, is because if cap rates go up and you can't bring up NOI at the same time, values go down. And I just think we're seeing conditions where that is very likely. I'm not saying it's for sure, but I do think there is a lot of risk in the commercial real estate market, more than there is in the residential real estate market. I will caveat this, that I will say that there is value add can still work. Like I said, if you buy an asset that needs repairs and you can repair it, you can improve your NOI, and you can also lower your cap rate. That brings up, if you improve your property, you can charge more for rent. You can, charge for parking or whatever it is that you do. You can increase your NOI. The other thing is that, like I said, cap rates are a function of what people are willing to pay. And usually properties that are stabilized, which means that they're in a really good shape, in a good location, sell at a lower cap rate. And so if you improve a property, if you stabilize it, you can increase the NOI and sell at a lower cap rate. So value add investing in multifamily still could work. But I just want to caution you that even that could be affected right now if you're not experienced at this. So I personally think those are really big risks. I'm not going to get too far into it in this video, but there are other risks in commercial real estate right now as well. Specifically that there are balloon payments and refinances that need to come up. Commercial loans, you can't get like a 30-year fixed rate mortgage. Usually it's like a 5-year ARM, adjustable rate mortgage, or a 7-year ARM. And for people who bought 5 or 7 years ago, they're going to have to adjust their mortgage rate right now at a time where they're going to pay a much higher interest rate. And that's going to put a lot of burden on their cash flow. That means that they might have to force sell. There are all sorts of implications to that. So that's a whole other topic that I'm not going to get into right now. Overall, my message to you is be careful in commercial real estate right now. I'm not a doom and gloom person. I'm not going to say things are all going to go to zero, but I do think that there is a significant chance that we see commercial real estate values decline by at least 10%. Personally, I wrote up to 30%. I don't think that's the most likely scenario, but between 10 and 20%, I do think is a relatively realistic scenario for commercial real estate values over the next couple of years. So thank you all so much. If you have any questions or thoughts about this video, hit me up on Instagram where I'm at The Data Deli. Thanks for watching. I'll see you next time.